Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome, everybody, to the program. Thanks for being with us. I'm Chris Boyd, certified financial planner practitioner, and my co-host here is Jeff Perry. We are both with the AMR team of Wealth Enhancement Group, and joining us as well is Russ Ball, our new addition to our team here at the office. And the three of us have plenty to talk about with some year-end planning. And Russ, not your first episode, but you're an old pro now.
Yeah, one under my belt.
yeah. So I was thinking we'll talk about year-end planning in just a minute. And as I started thinking about this, I don't know about you guys, but we've already started listening to the Holly channel and the Christmas music coming through. A little bit early, I admit. However, when you think about how late Thanksgiving is this year, Thanksgiving is the last week of the month. It's
right,
like just days before the
28th. Yep.
And then we have a very short season of the holiday season. Hard to believe that there's less than 6 weeks till Christmas. The year is rapidly running past us.
Once again, I was looking at the CNBC this morning, and they had a guest on talking about the holiday shopping season being 5 days shorter than is typical.
There you go.
Yeah. So pressure on, shoppers.
So it's going to start earlier than you like because,
it's going to be compressed.
Really you know what I mean? Yeah. You know what I mean though? So have you started your Christmas shopping yet there, Jeff?
I have not officially started. I actually started thinking about it during the episode that I was referring to about holiday shopping and thinking, well, I guess I should think about it. How about you?
As far as I've gotten, I've just started like,
you're more of a late shopper, if I remember right.
Yeah, you're right. I'm a procrastinator at times.
I'm a planner, so I will get it done early. And we travel. I'm in Florida, so we travel back to the Cape and Rhode Island for Christmas. So we ship our gifts.
Oh yeah.
To
you gotta plan ahead a little bit.
To Lisa's, my wife's mother's house. So we have to plan a little bit, right?
Yeah, that's a good point.
Right.
Yeah, I guess my default is why put off till tomorrow what you can put off to the next day. Not always, but that I've gotten better, but that's not my nature to be as well planned. I've improved as I've aged.
Yeah, like a fine bottle of wine.
Right? There you go.
How about you, Russ? Are you a planner or are you
a procrastinator?
Running in on Christmas Eve looking for something?
Usually with gifts, it's I'm a planner. I usually like to do my research on what I'm going to get. I really put it all together, and then
spreadsheet.
Not quite.
Okay, just seeing how crazy you were. That's all.
Yeah.
But I'm always looking for those deals that are out there. So whenever I see one of those, I jump on it. And
that's true.
Yeah, that's usually kind of my game plan.
That's smart. Yeah.
Well, I mean, it does leave us when you think about how quickly the year will come to an end. And, I don't know if you guys find this, but December always has so many activities with, gatherings, but also, just we have like club events and things like that with the Holy Cross Club of Cape Cod or whatever it is. Different groups that we're involved in have activities, and man, it just gets so busy.
It does. And so it gets busy too with your opportunities to make strategic financial moves, whether it be tax moves or investment moves. And sometimes if you wait too long, you don't have time to get them done, right?
Yeah, I think that's really a good point. I mean, let's just talk in terms of year-end distributions for people who are subject to RMDs. it's tempting to put it off till the very end of the year. Squeeze every last juice of, every last bit of juice of the market performance till the last end of the, and then take your distribution.
Especially for those people who we're talking about required minimum distributions from IRAs. If people didn't get the letters that we use, but
Yeah, good point.
if you are in that situation in the RMD age, you might not need the income. We have plenty of clients who, if it was up to them, they wouldn't take their own, right? So putting it off a little further is kind of a natural thing when you don't need something.
Yeah, yeah. But what ends up happening is there's a mad dash at the end of the year where
Right.
everyone's trying to get it done simultaneously, and the custodians oftentimes will say, "Well, it's best efforts." At a certain point, they don't commit to getting it done. So do it now.
Yeah.
Because it's getting to the point. If you wait till December, you might not get it, even though you plan to. Even if you say, "Well, it's a month away," but it can be, or 2 weeks away, or whatever. It can get really crazy at the end of the year. So doing it sooner is better. It's also, particularly those people who have inherited IRAs, tend to forget about the distributions they might have to deal with. You get a little bit of flexibility this year, but that's going to come to an end. So you gotta be starting to plan this more thoroughly.
Chris, speaking of getting things done at the end of the year, are you seeing more people? I hear about it more. I don't know if it's just more education or people are really using their RMDs for charitable donations. Are you seeing more and more
I
of that?
am. Yeah, seems like it's really catching on. I know we've talked about it a lot. I
Mhm.
think our clients are, inclined to be mindful of this. I find I mention it a lot more,
Mhm.
and I think it is something that people are more enthusiastic about. A qualified charitable distribution is essentially the opportunity to take money from your IRA if you're 70 and a half or older, even if you're not subject to an RMD until
Right.
73.
Good point.
Rules still apply for people 70 and a half and older. So when you say, "Hey, I want to give $1,000 to my alma mater, um,
Mhm.
my church, my favorite local charity, whatever," right?
Right.
Um, if it's essentially a nonprofit, what's the 501 type
C3 or other. Yeah.
typically, but yeah, so 501c
Yep.
type of organization. Um, well, you can get the opportunity to take that money out of your IRA, not pay an income tax when you take it out, if it's done through this proper way.
Right.
Excuse me. And still fighting a cold. Um, you can take it out. It goes directly to the nonprofit entity. They don't pay tax on it as a nonprofit.
Sure.
You don't get a taxable event. And so that's a win-win. Everybody, it also, if you do have required distributions when you're 73 and older, you can count that $1,000 as part of your RMDs,
Mhm.
even though it went to charity and not to you directly, and you don't have a tax consequence from it. So kind of a win.
Definitely a win. It's always great to be charitable, but
Yeah.
if you're giving the money away to the charities, why not do it to your advantage as well?
Yeah,
And at the end,
what's the alternative, right? You're
right,
taking money out of another account, possibly paying capital gains tax or some other tax. It's money that's post-tax, whether it's money you earned or whatever. It's
Mhm.
post-tax money that then you give to charity. This is pre-tax money that you're giving to charity and no tax event. So
In
definitely,
theory, your charity is getting more money. If you were going to withdraw $5,000,
it's a good point.
pay taxes, and then give the money to charity,
You'd be giving them $4,000 or whatever it
right?
would be. Yeah. Yeah.
And this strategy is enhanced by the fact that more and more Americans are using the standard deduction, so they're not writing off their charitable deductions on their tax return,
Mm.
right?
Yeah. So because of the Tax Cut and Jobs Act, that that's something else we'll want to talk about a little bit. But
I think so. Yeah.
um, the when that came into implementation, 2017, I don't remember what year it was, but when it came into implementation, it really increased the standard deduction, doubled it essentially for most people, and it set brackets at higher levels, and it
And limited some deductions,
and
caps.
the rate
Yep.
was lower, and yeah, so all these,
Right.
yeah, that's right, limited the SALT, that
State and local tax.
state
Yeah.
and local tax deduction. A lot of other things were changed in that legislation, but it made it more likely you're better off doing a standard deduction.
Right.
Um, so I don't know, is that where
Yeah,
you?
which means you're never going to be able to do, if you're giving the traditional way of taking money out of your IRA, for
Yeah.
example,
You'd have
and
to
then
take a lot out to get a standard deduction. I mean, to beat the standard deduction.
right. So
I don't
most people think that they're writing, they're still stuck in that old mindset. I write off my charitable donations. I talked to an accountant a couple of years ago, and he said that people are still giving him lists of their deductions.
Yep.
The charities, they're all these checks and things that we do when they haven't claimed a deduction on because they're on the standard deduction for years.
Yeah.
So I think people still in their head think if they donate to charity, they're deducting it, and 80% of the people are not. They're using the standard
point.
deduction.
From what I understand, another benefit of taking the QCDs is that you can reduce the amount that's in your retirement account, thereby reducing the RMDs moving forward based on a percentage.
That's a good point. Essentially, you're less subject to future tax by having done that. Yeah.
Or doesn't it? Well, yeah, because it reduces the RMD amount that you need to take. Even if you're between 70.5 and 73, you can start kind of taking money out of the retirement account for
Yeah,
QCD.
that's exactly right. So when you have a distribution requirement, they take let's call it a percentage of the value. Usually starts a little under 4% of the value of the account to create your distribution. If you've given some of that money away over time through maybe this process, well, you don't have as much that you have to take out.
Right.
So that's a good point.
That brings up the broader subject of of individuals who are not required to take a distribution, but should they take a distribution before they're required to? Because
So you mean those people between 70.5 and
73,
in this
75, maybe, right?
qualified charitable distribution, or are you talking about just withdrawals or
Withdrawals generally.
Yeah, I mean, I think that's a fair point. The question becomes, if we put it off too long, air quotes, too long, does it compound greater and greater, pushing us potentially into higher tax brackets?
Right.
That if you started that process sooner, whether it's through conversions, if you didn't need the cash, to spend, or if you did, try to draw from it intentionally to have your tax rate be more predetermined, more intentionally decided.
Yeah, being more tactical about it, right?
Yeah. And I mean, let's talk about this topic of year-end tax planning, Jeff.
Sure.
I mean, that was kind of the prelude we had in mind for this segment. And as we talk about this, you mentioned there's a nice little checklist that we can share with our listeners that could be a real resource for them as they think about getting ready for year-end planning. Do you want to mention that a little bit about that?
Sure. We have a 2024 tax planning checklist. Covers a wide variety, and it's just a couple pages, something that we can email you if you send us an email. It has categories if your income is higher than maybe it was last year, if your income was lower, strategies to use. It talks about perhaps delaying some income or accelerating some expenses. Even goes into subjects like 529s in education related planning, gifting, estate taxes. So it's a broad category, and it's some of the things and some of the things you probably think about, but it may have a gem or two in there that will get you thinking and allow you to make some of those last minute, air quotes again, changes to your tax planning and save you some money.
Hey, if you'd like to get a copy of this, you can just send us an email, amr-info@wealthenhancement.com. That's amr-info@wealthenhancement.com. This is a complimentary thing where there's no obligation. We're just going to send you out some good information. And if we can be a resource to you, we're happy to be a helpful resource for your planning along the way. Check it out. Take advantage of it. amr-info@wealthenhancement.com. Jeff, why don't we talk about some of these, ideas of things to remember as we're moving toward year end?
Sure. Where do you want to start? Some general year-end tax planning.
Yeah, that sounds good.
So we talked about RMDs. That's one of the ones. And we didn't talk about if you don't take your RMDs, what happens. There's some changes that are. We're not suggesting that you don't take RMDs, by the way, but there are some favorable changes to the penalties, right? This year.
Yeah. So it used to be that if you didn't take your distribution requirement, it was a 50% penalty on the amount you didn't take. So if you took out some but not all, the part you didn't take out, 50% penalty tax. If you didn't take any, 50% penalty tax on the entire amount you were supposed to have taken. Incidentally, for most people, you really do have to take it out in the calendar year that you're dealing with. And if you are in a first year, you just turned 73, and I think it's for those who are had a birthday after a certain point in time. I think it's April. You do have the opportunity that you could carry it over to the next year, but don't, because then you have to take two distributions the following year, the one for 73 and the one for 74. So not a good idea unless there's very specific circumstances that it makes sense. In any case, generally don't do that. So if you didn't take it out, there is an opportunity to rectify it and then get a reduced penalty. So right now the penalty is 25% if you didn't take it out. But if you then rectify within a very specific period of time, you can reduce that penalty to 10%. Yep. So it's a little bit changed from what it used to be, but still, don't have that as a problem.
Yeah. It's avoidable.
Don't be a procrastinator, right? Yeah.
Yeah. So another subject that comes up at the end of the year is should I take some losses to offset some gains that I've already done? Maybe you have some capital gains from, maybe the sale of some holdings that you had. And so at the end of the year, we usually talk about tax loss harvesting.
Mm-hmm.
I don't know if that's going to be it's been a good year.
It's been a good couple of years, really.
It's been a good couple of years. Good point. So unless you have
it's going to be less frequent for most people this year that you have the opportunity for much in the way of losses to harvest. Where might people have some losses? If you have some individual securities and you didn't have good picks, you might be able to say, well, why don't I harvest that loss? I'll sell that security. You could always buy it back after 30 days, so more than 30 days. They're essentially the rule to allow for this wash rule. So you could buy it back if you said, I really want to have that stock. I think it's a good opportunity, but might allow you the opportunity to harvest the loss, be some strategic in your tax planning, since you have gains maybe somewhere else. You might have some bond funds.
I was thinking some mutual funds or ETFs. Yeah,
we've had some good results with a number of the funds that we're using, but I think some people have not had as good a result with some of their bond fund selections, and it's going to vary from client to client and circumstance. But just there are circumstances where people might have seen some price erosion, even though they might have made money from the income from the fund. They might have had some price decline, and that can create an opportunity for a modest capital loss. And, if you're essentially going from, Fund A that owns basically the same kind of bonds as Fund B, technically you're repositioning a loss, but, you can do it in a way that you're not really missing out on exposure to where you want to have exposure
Right.
in broad stroke.
That's the only general category that I thought of: longer duration bond funds, or just total bond funds, total return bond funds.
I think something like that is a good point. There might be opportunities for some investors in that space as a predictable. But again, I think bonds have been getting, people come in and say, oh, bonds aren't making any money. That's not always true. You might have bond funds that have made money. Depends on where you are in the scheme of, the range of bond positions.
Mm-hmm.
And so, I don't want to give people the impression that bonds always lose money. I often hear that from people.
Another thing that comes up in the context of a good year for equities is, have I made, do you make estimated payments, and have you considered your capital gains and your distributions from mutual funds? If it's been such a good year, you should expect that you're going to have 1099s with maybe some good gains embedded into your mutual funds, or straight capital gains if you sold some stocks that you had in your portfolio, which typically you're not withholding taxes in a brokerage account when you sell a stock. But
let's talk about those. Break it down a little bit.
Sure.
So we know this is one of the reasons why ETFs have become very popular. But explain what you're talking about when you're talking about the mutual funds and distributions and so forth.
Sure. Well, to set the stage, we're talking about in a taxable account, not an IRA, right? So if you have a brokerage account, or you just happen to own mutual funds direct from a family of mutual funds, they do all this trading and repositioning, and all the things that they do is consistent with their strategy. And many of those are transactions where they're buying and selling things, and they pass along those inherent gains which are inside the mutual fund to the shareholders at the end of the year. And so
imagine you owned a mutual fund.
Right.
We're just going to make one up. It's the car fund. And in the car fund, you owned Ford, Tesla, Goodyear, I don't know, all these different things that deal with cars, things related to cars.
Sounds like something you think you'd like to create here.
No, just like it's an easy example, right?
Okay.
So, and the symbol, of course, is going to be car, right? No, but anyway,
you're giving this thought, I can tell.
Auto X or something. I don't know. Maybe that'll be. So anyway, this fund owns all these different companies,
right?
And the manager of the fund is buying and selling these different securities inside the fund. And if over the course of the year, more of those transactions that they incurred where they sold some securities, maybe they turned around and bought some other stuff, or maybe other people were liquidating their position in the car fund and decided they're going to use that money. So more money flowed out. So they have to sell stuff in a mutual fund to make it available, either for repositioning for a purchase of something else or for liquidity needs, whatever the reason. There's transactions in that process. And if more of those were gains than losses, which
this year is probable.
Yeah. The fund distributes those gains to its current shareholders as of a certain date. And this is that time of year when we start to hear about, what's going to happen, who's going to get how much of a distribution, what's the tax implication. So if you're in a mutual fund, particularly outside of an IRA, but in an individual joint trust, that taxable account, you very well may be faced with some distributions that have a tax implication. And this is the kind of thing that you can't always control by virtue of, good fortune of the market having gone up. The worst is when this happens, when the market goes down and people are liquidating the car fund because they want the plane fund. I don't know. Whatever it might be, they change what they want, or they, now they don't like stocks, they want bonds because there's, dicey markets or something. And the fund has to sell stuff and still distribute a gain. Might have been benefited from a year or two ago, but you might end up getting the capital gain because they end up having to sell stuff which creates a gain event.
That happened a couple of years ago to a lot of people.
It happens routinely when there's downturns.
Mhm.
And that's one of the drawbacks of mutual funds, that ETFs have a leg up where, in my case, if I sell stuff, I have a capital gain.
Mhm.
If you sell stuff, it doesn't affect me in an ETF generally, right? Whereas in a mutual fund, if a lot of owners sell, I might end up as the existing remaining shareholder getting a distribution that has a capital gains distribution, kind of unfairly, if you will, but
Unexpectedly.
unexpectedly. There you go.
Right.
So you started to make that point that that's something to be attuned to. You might have more of these, and you might need to be thinking for estimated taxes.
Mhm.
You also started to say something about individual securities. Where were you going with that?
Well, I was going that if you have capital gains in a taxable account, you typically don't withhold income
In a
tax from it.
taxable account, you don't have the
Right.
option to generally, right? Yeah.
Right. So if this is a
Unlike
year
an
that,
IRA, if you pull money out of an IRA, they can withhold
yeah, it's usually
funds for taxes.
a question. Would you like to, right?
Yeah, you have that
Which the
option.
answer is hopefully yes.
Yeah.
I'm just saying this could be a year that you have some capital gains, whether you know about them in a individual security that you sold, or you maybe should expect your 1099s to have something.
Good point.
So, or you maybe had your income went up and you didn't have the right withholding.
One of the things that this tax planning checklist that we have available, if you want to benefit from it, just reach out to us. We'll send you a copy of it, and you can go through it and see how it applies to your situation. You can send us an email at amr-info@wealthenhancement.com. It gives you thoughts of, well, what if your income is higher this year than last year? Or conversely, what if your income's lower this year than last year? Some techniques, some checklist of, hey, you might want to consider this or that. Can be very different from one thing to another. And there's still time, but you're running out of time. You got to deal with some of these things soon. So if you haven't taken advantage of these kinds of offers, to jump on it right now, amr-info at wealthenhancement.com, and we'll get this out to you in case it's something you could benefit from. Anything else that's maybe a good year-end tax planning thought, Jeff?
Well, on the not so much the deduction or credit side of the ledger, but it can be a great opportunity to reduce your taxable income by making contributions, right? Additional contributions into your qualified retirement plans.
Yeah, you want to try to max out if you can, or as much as you can. You have to do this through payroll deduction, but it might be the kind of thing to talk to your employer, your HR department, or whatever it is, payroll, to say, hey, with the remaining months, remaining paychecks, or if there's a bonus or something, what do you want to happen? How would you like your funds to be handled as it relates to your retirement plans? Or is there an opportunity to maybe stash a little more in your plan if you want to?
Yep.
That kind of thing.
And if you're self-employed, you may have some extra opportunity to do that if you have the right type of plan set up.
Absolutely. And I think, with self-employed people, there's a lot more flexibility on, sort of how you think about sort of opportunity to defer income into a future year, or do I want to accelerate some expenses that I might be in need of anyway, but could, try to offset maybe if I had a bigger income this year. Yeah, you can try to be a little bit tactical on some of these, planning your profit and loss a little bit.
Yeah, not specifically related to taxes, but at the end of the year, and people start to think about goals for the next year, I think it's also a great opportunity to increase your contributions. If you're typically, a lot of people when they get a job, if the employer matches 3%, they'll say, okay, I'll do the 3%. I'll get the free money, right? And so they start. But I think it's a great opportunity with a new year if your cash flow If your budget is working out for you well and you're doing fine, like go to 4%, right?
Yeah. Yeah.
And it's also a good time if you have children who are going to hopefully have some future educational expenses. If you haven't started a 529, it's a college savings plan, it might be a good opportunity to think about that.
Yeah. Good point. Good point.
It's a good time. Any time's a good time to put more money away towards your future and for your children. But at the end of the year, I think people are more thinking about these subjects. So that's why
I think another common thought is on the investment side, Jeff, is as we get closer to year end, you give second thought to what changes do I want to make?
Right.
Maybe is this something I want to make this change, but should I wait until next year so that I can push that tax consequence into next year's problem instead of this year's problem? You were talking about those distribution considerations. Do I want to be buying a fund that may be bringing into it a big distribution?
Yeah, you can buy a fund the day before the distribution decision is made
and get whacked with a tax consequence
for gains that you never had.
Yeah.
Right.
Yeah. So now in an IRA, it might not matter because you get the distribution, it gets reinvested. It's kind of a wash, right? There's no tax event in that circumstance. But in a taxable setting, those are some things to be like, this time of year, you want to be mindful about. Don't forget, these are things to be paying attention to. And you know what? There's so many things to be thinking about. Sometimes it's hard for people who don't do this day in and day out to be on top of it, right? So, if you need help, don't hesitate to reach out. That's what certainly we're here to do. If we can be a resource, we're happy to be available to you. We offer a complimentary consultation. We are a fiduciary, we act in that role where if you're doing a great job and we think there's not a need for you to do something different, we'll tell you. If there's some way we can be of help, we'll lay that out too. And maybe that's something we'll talk about in another episode is some recent conversations we've had with clients or prospective clients. And the kind of things that come up from time to time is sometimes it's helpful and sometimes it's up to them to decide whether it's helpful or not. But if you need some help, you can reach out to us. Our phone number is 866-771-8901. And you can always reach out to us again for that complimentary tax checklist, year-end tax planning checklist. Or for any other reason, you can connect with us at amr-info@wealthenhancement.com.
Don't forget to start your Christmas shopping.
That's right. And start early before Thanksgiving this year because it's coming fast.
It's always faster than we think.
That's right. All right. Well, thanks for being with us. And if we can be of resource to you in any way whatsoever with your financial planning or your portfolio management, reach out to us at Wealth Enhancement. And we've got a great team, not only in our office, but throughout the company. There's a roundtable of experts, and we're happy to be a resource to you. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901 or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.